Welcome to The Resilient Investor with me, David Stevenson. In each of these episodes, we try and walk beginner or sort of early stage investors around the myriad opportunities within the world of investing, particularly the world of investing on the stock market. And we spend quite a lot of time talking about funds because funds are a good way of buying into kind of diversified exposure to certain themes you want to invest in, be it US equities, biotech, or private assets. And in the last couple of episodes, we've actually talked quite a bit about alternative investments. And there's a reason why we talk about alternative investments quite a lot. It's because actually, if you're a UK-based investor and you invest on the London stock market, which, by the way, is not necessarily a given these days because you know how many UK investors invest in US stocks, but that's another story for the government to deal with. So let's just invest in UK equities. There's a large bit of the UK market, particularly in the fund segment, that is actually invested in alternative assets. And you might wonder why that's so interesting. And the reason it's interesting is because the world is increasingly going private. What do we mean by that? Well, if you run a very successful company and you're growing quite fast, you face a couple of choices. You can either stay private, but you need access to capital to be able to grow more. So you just want to keep growing. So how do you keep growing? You might list on the stock market. Well, good luck on that. And good luck on doing it in the UK, which is a tough old market to list on. Maybe you go to America. But, you know, listing as a stock market company is not without its problems, let's say. Or you might stay private and you might go and talk to people who might provide you with capital to grow your business. Thus, we enter the world of private equity. And in the UK, going back to the UK market again, we're actually quite lucky that the UK market has quite a lot of really quite high quality private equity players who've got listed funds. And I've got with me Stephen Tredget, who's a partner at Oakley Capital, and they run an investment trust, very successful investment trust, OCI, Oakley Capital Investments. That's exactly what they do. They go after private businesses and it basically give them capital to grow. And I want to talk through, Stephen, with you about why that's an interesting thing for investors to look at. So first of all, let's just go back to basics. What is it true that there are more and more businesses bigger businesses wanting to stay private longer, and why?
David, first, thank you for having me on. And
Pleasure.
Secondly, absolutely. I mean, the number of listed companies is shrinking. It's
Yep.
kind of halved over the last 10 years. And that's the same here in the UK as in the US.
Yep.
Secondly, and I'm reminded in 2016, I used to be an investment banker for my sins.
Oh.
And I traveled up the M1 in my kind of, my team of bankers, my flash PowerPoint to see a growing UK logistics business.
Yep.
And I was to pitch them coming to the stock market.
Yeah. I called an IPO, and the initial public offering.
Exactly. And I was laughed out of the room. I mean, not
quite like that, though.
Yes,
I see.
similar. And the reason being is, a combination of reporting requirements, cost of listing, the restrictions around M&A, the growing regulations around. I mean, the list was endless.
It was quite a long list of things.
The CEO trotted them out. And they then subsequently went on to be backed by one of the UK private equity players that you mentioned very successfully, where they had one investor who had significant deep expertise in this space. It was uncomplicated. They were able to, kind of be aligned on reward, and that turned out to be a very successful decision for them. And that is the decision that more and more companies throughout the UK are taking. The way you describe PE is quite right. It's often investment for growth. It's founders looking to grow their business, but also they don't just want capital, they want expertise. Yeah. They want help with digitizing, talent, professionalizing, M&A, a whole range of different things, which PE, as a control investor, are set up to provide. We may only make 6 investments a year. We've got in total 28 today. And to support those 6 investors, we have, 6 investments. We have 170 people. 55 of those are dedicated just to those portfolio companies. And we are, we'll be 2 or 3 people on the board. We'll be communicating with those companies on a daily, if not weekly basis. It's a completely different construct to a public equity kind of experience where essentially the governance is limited to, what's imposed on them by the listing authorities.
Which is quite onerous.
Which is
So I just want to spend a little time to talk about the private equity model itself, and then we'll look at the opportunities and the risks. Now, what's the exit? You don't do it as a charity. You do it to make money. So presumably the way that you make money is that you you IPO them, or do you sell them on? So what typically happens to businesses in a typical PE portfolio? How does the investment get realized?
I'll talk initially from an Oakley perspective. That's the one I'm most familiar with. I mean, in our case, Oakley is backing founders in small to medium-sized European companies.
But what do we mean by small to medium-sized? What kind of revenue?
So they are. Let's talk about enterprise value.
Okay.
So they'll all be profitable, and they'll be making they'll be valued in the region of 100 million up to about 2 billion.
Okay.
In size.
Okay. So they're not tiny.
They're not tiny. The majority of these businesses are established. They'll be making anywhere between kind of 10 to 100 million of earnings of EBITDA.
Yeah. Okay. Fine. Yeah.
So they're established, and the founder will have, will want to remain in those businesses, want to grow them further, and is looking for the first time to allow private capital onto the balance sheet. So in 90% of the cases, we're the first ever PE investor they've ever had.
Right.
We are then, as I mentioned, kind of professionalizing, adding value, helping that business grow, doing a bunch of the messy work that they're complex at this stage in their ownership. They've only been owned by one family, one individual. You can imagine that they need help with accounting, management information. Most of the control and knowledge coalesces around one individual, and they need help to expand. And so we're going to do that work. We're going to get them to a certain size, and then typically it's bigger financial sponsors that are then the buyers of these assets.
What do you mean by that?
So that means the other large global PE players.
Okay, all the big names you've heard of.
Exactly. So our last 8 deals were 2 were sold to CVC, 2 to EQT, 1 to KKR, 2 to Silver.
So quite often that you sell them to another private equity player.
We are doing the hard yards to create something of a bit more scale, and they're looking to buy, large mid-cap, let's say, businesses that are still growing, that they can continue to work with globally.
Now, one of the things you will have obviously heard over the years, many people saying, private equity, and you're just addicted to debt.
Yeah.
I mean, that word, I'm sure it's not the first time I've ever said that to you. What do you say to people who go, well, it's just hard to ask money, and you just load it up with debt? And the reason I ask that, because, of course, the world's now changing. Interest rates have gone up. Yeah. And a lot of people go, well, that means the model's broken, doesn't it? Yeah. Because in the world of higher interest rates, you can't just load up the business with loads of debt.
I think the first thing to say is that, we, even here, we're discussing an entire asset class under one name. Private equity.
Very broad.
Absolutely. We don't talk about, if we were talking about investments in public, we wouldn't describe them all as public equity.
No, that's true.
And so with that comes many different styles and flavors of private equity, and many different, stages in which private equity spans from seed capital, from day one investment, all the way to very late stage. Yeah. And of course, debt has played a very different role. The earlier the stage of smaller companies, the less debt you're going to apply. Higher risk, you don't want to put debt in. Yeah. Much, much bigger companies, slower growth, debt and financial engineering plays a bigger role. Yeah. And so there's absolutely no doubt that, the use of debt at that level, or the impact of debt at that will have been impacted by higher rates. Yeah. There's absolutely no doubt.
And that's more your kind of big buyout shops, isn't it? You hear that, because they'll quite often buy a slow-moving unit and buy it out.
Exactly. And then for the purpose of this conversation, as you pointed out, the cohort of listed PE trusts doesn't really involve any of those kind of Goliaths of the kind of PE world. The majority of us are using debt as a growth tool, right? Not to kind of, stick in equity, leverage this thing to the hilt and move on. We're doing it to help them expand. We're doing it to help them to buy companies. And in the main, it's done relatively modestly.
So give me a typical, it's very difficult, but what would a typical deal look like?
Well, a typical deal for us tends to be, we go in largely using equity in a mid-cap deal. We want to get to know the business, understand the kind of appropriate level of leverage, if there is one. And then over the course of time, as the growth of the business, we understand the cash flows of the business, we then may introduce leverage or more leverage into the business to de-risk the investment. And obviously, there's different companies you can take different approaches to how much debt they can support. In most cases, and you mentioned this right up front, we're talking about growth businesses. We're talking about those that have, in our case, 75% of them will have recurring earnings, so it's subscription-based earnings.
Yeah. So that means kind of stuff that renews every year, and it's quite sticky, isn't it? Probably
it's sticky. There's clarity. There's the ability to forecast very clearly.
Yep.
Secondly, a lot of them, as you mentioned, are digital businesses or tech businesses, and that means that there isn't an awful lot of capex.
Yeah.
Of costs underneath that EBITDA line.
Yeah.
So most of what you generate in earnings,
Probably quite high operating margins, aren't they?
Yes, exactly. So a lot of that converts to cash.
Yeah.
So you're in a position where a lot of these businesses can support the debt quite easily, and the debt multiple falls relatively quickly.
Yeah.
In PE terms, I mean, actually within private equity, the number averages somewhere between 5 to 7 times.
Yeah.
So there is. Don't be, we should be flippant about the level of debt within private equity. It can be quite high.
Yeah.
Some use it more than others. Yeah. And I'm sure in the current environment, people are being more conservative. We are certainly introducing more equity than debt.
Yeah.
But also, if you choose your manager appropriately,
yeah,
most of them and most of the listed cohorts are reasonably conservative about how they use debt.
Well, that as you say, they're reasonably conservative. There's about, how many listed PE funds are there? There's probably about, a dozen, 15, 20, something like that?
There is. Yeah. And, kind of 10 plus of them are fund of funds.
Yes. So and what we mean by that is they invest in lots of different individual fund managers.
Yes.
And they give you diversified exposure.
Exactly.
Which has its advantages and it has its disadvantages. Just it's horses for courses, isn't
Absolutely. Indeed. And then the remainder are what we describe as direct listed PE, where they back one single manager, as is the case with ourselves, and HG, and Apax.
And the big name, of course, is 3i, which everybody in the UK is probably, or should we call it Action Retailing?
Absolutely.
Okay, so you got that choice. It doesn't always show up in the share price, though, does it? That big, and the sector's had a bit of a tough time. Well, apart from 3i, but the sector's got a bit rough time over the last couple of years. The sector's always traded at, well, not always, but many of the funds in the sector, even a single direct PE firms, are traded at a discount. The discounts have widened, haven't they? And I suppose people are worried about higher interest rates. They're worried about valuations, aren't they? They're worried about whether or not, people have got inflated valuations. Why do you think the discount is so high? What's your discount at the moment?
About 30%.
Yeah, it's quite high, really.
Yeah.
How does that compare with your long-term average?
So, I mean, we've traded as close to kind of par, and we've been, kind of long range averages, kind of 15 to 20%.
So it's quite a bit above your long-term average.
Absolutely. There's a number of things to say. I mean, you talk about PE having a hard time, when actually, performance-wise, if you look at...
I meant share price terms, but in performance...
But in share price terms, I mean, we're talking about, ourselves and some of the names we've mentioned have been producing shareholder returns of around 20% compound for the last 5 years.
Yeah.
So, yes, the prices may not have kept up with NAV per share, which is the discount. You take the total assets, you divide it by the number of shares. That number is a lot higher than the share prices currently. But the share prices largely are tracking the increase in NAV.
Right, okay.
But it's just these persistent discounts. And I kind of maintain, if you take the view that private equity is an important part of an economy, is an important asset class.
Which you should maybe have in your portfolio, because that's my point.
Is set this aside. This is like, it's estimated that 20% of the UK GDP is companies backed by private equity.
Quite a big number.
And not only that is a section of the economy which is probably quite disruptive, new economy, tech-driven, so exciting types of businesses that maybe even in sectors that are not even on the public markets.
Yeah.
So it's a decent chunk of the economy, and it's in a really interesting.
So you almost think about, you almost have to ask, why wouldn't you have some exposure?
Exactly. Let's start there. Then you've got the relative performance, and if you take, kind of global PE performance, or you take even the listed PE index, or you just take OCI, every one of those three would have outperformed most public equity index, all the public indexes over.
Wouldn't have been too difficult.
3-5.
Because the UK market's been so terrible. But I'm being facetious. But
take that over 1, 3, 5, 20 years.
Yeah.
There is significant outperformance. So then you've got it's a big chunk of the economy in a really interesting part of the economy. And then you've got outperformance. And that performance, that growth in the NAV tends to be what drives the NAV.
Yeah.
Now, why do we focus on discounts? It's because it's quite hard. And this is the challenge for anyone listening to this and thinking about should I invest in PE. It's quite hard for anyone analysing these assets. Is that in some cases there might be 1,000 different companies, private companies invested in. How do you take a view as to what the values of those? In our case, it's smaller, but it's still 28 companies.
Yeah.
And it's not like public companies. We're going to give you a lot of information, but it won't be. We're not going to give up all the information.
Yeah. So how do you value? That's a question I expect a lot of ordinary private investors ask: is how do they come up with these values? Do you just sort of sit there and build a model and say, "Well, I'll put these numbers in," and it comes out and it spews out? How do you do it?
It's a great question. It gets the nub of people's confidence around what is that NAV, what is that net asset value, and how can I trust it?
Yeah.
And so there is the manager itself will value these businesses on a quarterly basis,
right?
And so it's taking a view based upon historic performance.
So how do you value it? What numbers do you put in? Presumably you've got a model.
Oh, absolutely, vast models. And bear in mind, before we make an investment, we are doing, in some cases, years of work on these businesses. We're insiders in these companies, and it is it's a team of up to 10 people analysing everything about this business, and we spend, in some cases, millions of pounds in the process of understanding these companies. It is an incredible operation.
So models, and what do you put in that model?
Well, I mean, every single bit of financial data and forecasting around not just them, but their cohort of peers.
So you do compare it. So you compare it with other transactions.
Absolutely. And then when we're valuing the business, we're valuing it on a whole bunch of, we'll look at public market comparators, we'll look at private deals and what prices they've done, and we'll look at comparable business that we know and operate in it, and you form a view around price.
So you come up, so you've got business A worth £100 million, for argument's sake.
Yeah.
And then presumably you write it, and then the board has to agree it, and the auditors have to agree it. Do they double check it?
So we have our own valuations team. Then that is in itself, kind of double checked, and we've got investment committees to do that. And then there's OCI, the listed vehicle, does its own external independent audit of those valuations,
which I presume is done by one of the big firms.
Yeah, I mean, it's done entirely different. No crossover. They're not in any way employed by Oakley or OCI to do anything other than this.
Yeah.
And there's analysis, and then I'd overlay on that a couple of points. One is, unlike in many other investment areas where you might be remunerated on the performance of those assets on an annual basis, within private equity, the only time you get any kind of performance reward is when you exit the asset.
Yeah, so when you actually make a hard sale,
when you
get some cash.
It is largely irrelevant what you're holding the business at during the time of ownership.
Yeah,
and actually, you're not incentivized to pump the value up.
Yeah,
you're not getting a bigger management fee. You're not getting a bigger performance fee.
So you only get the money on the exit.
Exactly, and so and the last thing you want to do is kind of have put the valuation at an unattainable level, only to find that you've got to drop it subsequently, kind of when you sell the assets. So there's very little incentive around that, and there's huge amounts of checks and balances to make sure you're putting in a realistic investment. The other thing is, often people point to the public market and say, well, hang on a minute, the public market's gone up 20% or down 20%. Why haven't you?
Yeah.
I think the thing that's happening in public markets, funds are flowing in and out.
I was about to say, and they're not always determined by valuation.
No, it
They're
could be
determined by sentiment or what the Fed does or any number of things.
Absolutely.
Bitcoin.
Possible shock. Yeah, possible other shocks. And in the junior stock market, it's been driven by significant outflows for quite a number of years. Point one. Secondly, I mean, we're talking about a number of companies that don't have peer group comparisons. One of our biggest investments is a German-based online degree university.
Because you're quite big in education, aren't you?
We are. That's one of our 4 key sectors, along with tech, consumer digital, and business services. And that business grows it's got about 150,000 students. It grows at 30-40% its earnings a year. And it's now increasingly a global business. There is no direct comparison.
I can't think of anything. It's a couple of American stocks, and that's about it.
There are some American campus-based universities.
Yeah.
They're not an obvious comparison.
No.
Who are you? The margins are, as you pointed out, closer to kind of software businesses, and the growth opportunity is huge. Now, we're holding that at a relatively modest multiple, but just because the stock market, went up or down, doesn't really change the prospects nor the likely valuation for that business. So there isn't quite the same volatility, and neither are we. We have permanent capital, so. Neither are we seeing funds suddenly withdrawn from us, nor are we impacted as closely by the stock market as people might think.
And let's turn towards the end now, just on what you invest in and where the opportunities are. We've actually just helpfully name checked the 4 sectors you invest in. How do they stack up? Which is the biggest subsector you invest in?
we're broadly, as an OCI investor, you're broadly split quite evenly between those four.
Oh, okay. So it's pretty equally.
Yeah.
And they're all quite tech orientated, aren't they?
They are, generally speaking. I mean, like 3/4 of those companies will deploy their products or services digitally.
Oh, really? Okay.
So tech's quite a liberal term. We're not like we're backing kind of, new IP or hardware.
Yeah, you're not trying to back tomorrow than NVIDIA, really.
No, absolutely. I mean, to give you an example, when we say, kind of digital solutions, some of these we'd be very familiar with, but we're backing them in countries where there just has been low adoption. I mean, one of my personal favorite examples is Facile. It is the price comparison website in Italy.
Oh, right. Okay.
Oh, great. Price comparison. And we've all seen.
All used it.
All used it. We know what the market's done. That, what's so exciting and why is that so high growth? Well, in Italy, solutions like that have relatively low penetration. Oh, right. So if you take, for example, car insurance here in the UK, price comparison websites, whatever, 80 to 90% of car insurance is arranged online.
Yeah.
You go to Italy, even after COVID, it's somewhere between 15 to 20%.
Wow, really that low? So
we are not taking a bet on the Italian consumer. We're not taking a bet on the amount people spend on their car insurance. We are taking a bet that slowly but surely, an online solution like this, much like every other, most other European countries, will slowly penetrate to the level that we anticipate.
So what are your, difficult maybe to say this because of the value, but what's your top 3 investments that are in the portfolio at the moment, just so people can get an idea of what you're putting your big bets on?
So they are IU Group. So that's online education.
Okay. Oh, yeah. Is that the ones you mentioned earlier?
Exactly.
Yep.
And so that is the kind of the mega trend there, that there is a increasing global demand for high quality, accessible education. And this is the ability for students anywhere in the world to study one of 500 courses at their leisure using digital solutions and, more importantly, kind of generative AI solutions, where you can have a kind of virtual teaching assistant that can teach you based upon your specific needs and requirements.
Is all this massive online learning? Is that same kind of market?
It's exactly that. Yeah, which is, in a number of territories, either there just isn't the opportunity for higher education, or in certain jurisdictions, there's been other solutions other than higher educations out of schools. And so that's kind of right up there with the kind of one of the biggest exposures and fastest growing opportunities. Then you've got Idealista. Idealista is the right move of Southern Europe.
Oh, right. Okay. So, I don't think we almost need no explanation.
Property portal.
I think we could work out what that is.
Exactly. And that...
Same kind of theme as the Italian price comparison.
That. Yeah. 10 years behind Rightmove,
okay,
where you're seeing the same levels of kind of growth and penetration.
I presume you're probably waiting for Rightmove to buy it. But anyway, moving on.
And then a third example, let's provide one here in the UK. Like we haven't done a huge amount of investing here in the UK historically because we've struggled to find value and quality.
Okay.
And also PE penetration is quite high here in the UK. Why have we been doing more now? Well, actually, all the things that are, kind of negative for business operation, like high inflation, high interest rates, kind of and difficult economic backdrop, whilst there are really a whole bunch of headwinds that make trading difficult, they also provide a huge amount of opportunity for investment. Yeah, because companies suddenly need. Yeah, one of the things that we should consider is the junior stock market's failing. Yeah. Interest rates high. Yeah, banks aren't lending. Yeah, private equity is part of the solution.
Yeah, absolutely.
Not only the fact that kind of people would choose to remain private if they can anyway. Yeah. And so this is, and just dislocation and uncertainty causes people to look to take on a partner, or they see the opportunity for huge amounts of M&A around them, and they need someone to help them do that. And kind of we are the kind of partner of choice for kind of founders looking to do that across Europe. And now we're finding opportunities in the UK. And if I could just give you one in terms of a traditional industry where you think, why is an Oakley kind of playing in here? And it's Steer Automotive. And that is a collision repair group.
Oh, right. Okay.
Sound particularly sexy, doesn't sound particularly digital. But this is exactly kind of where we play. This is a gentleman, Richard Steer, who founded this business a few years ago. He is able to take single sites, auto repair sites. Yep. Buy them on small multiples. Yep. Single digit multiples.
And they're probably quite often family or individual owned, aren't they? They've
run by an individual.
One person's built it up over the years. Exactly.
Will be low in professionalisation, lumpy in revenue, probably building around. They won't have any systems, etc.
Yeah. Oh, I'm just thinking. Hang on, dentists, vets. So, same kind of model, really. Isn't
so many business services. Are like
this.
Exactly.
It's classic business service.
Schools
model.
like this,
private schools, dental,
all these kind of different services we've kind of got into that are ripe for consolidation and professionalisation.
All right.
In this case, he can take one of those sites, he can double the margin in 12 months and double the revenue in 12 months. And he does that by the following. He introduces kind of rigor, control, systems. He is then able to get those sites licensed to work with the big OEMs. So it can be...
the big car companies.
Exactly. So, and as you move through the luxury car names, your margins and volume kind of grows.
Certainly, when you pay for it, certainly feels that way.
Right, yeah. We've all, many of us have that experience. And so he's able to initially get them business flows they could never ordinarily have achieved. And then once they are, kind of licensed under those big car manufacturer names, and they can provide repair solutions for them, you can then plug them into the insurance companies.
Yeah.
And the insurance companies are the big buyers of collision repair in the UK.
Yeah.
And he, just over 100 sites, is now the biggest provider of collision repair for the insurance companies. And there are 3,500 sites throughout the UK. So you can imagine the multiple arbitrage. You buy these things on relatively small multiples. You plug them into
the big network.
All that volume comes through to you at much higher margins.
And you start fishing in the pool of insurance companies.
Absolutely.
And they're big contracts, aren't they?
Yeah.
They don't go, well, just repair one car.
No,
you
exactly.
Repair 5,000 cars.
So there's a classic opportunity, not one that would be suited to the public markets, nor does Richard Steele want to be in the public markets. And then to kind of wrap that up, why would he choose private equity? Well, in this case, he wants someone that's going to help him with M&A. That's going to be, he wants a single partner. He wants someone that's going to sit with him on the board that he can trust. He was going to remain invested. He wants someone along the same lines as him, that he can grow this business that's already successful from $1 billion of value up to, our average holds about 4 years.
All right.
So at the very minimum, we have to double our money net of fees in those 3 to 4 years.
Yeah.
Now, in reality, I expect us to do, double again that in that period of time.
Let's finish off. But so, would you maintain that if an investor's sitting there with a pot of money for whatever it is, doing long-term investing, they probably should give some thought to allocating some of it to private equity? And of course, we can't give advice and blah blah blah, all those kind of things. But is your sense that investors are allocating any money to ordinary private investors? Yeah. Are they allocating enough money do you think, to the whole private assets market? You work in private equity. You've got other bits of private assets as well. I mean, in the past, we've talked about renewables and infrastructure as different segment again. Do you think it's under-owned in the UK?
Absolutely. I think it's under-owned and misunderstood. Now, it's growing. That's what excites me about it.
Yeah.
We're discussing this at a point in time where there's, it's not a particularly well-known market. It trades at a significant discount. So whatever risks and concerns you have, they are more than in the price.
Yep.
I mean, to make the point, OCI could sell a stake in the funds now, could go out today and sell it to secondary fund buyers. That's quite a deep market out there.
Yep.
And they could sell that at NAV today. So you could realise
the whole portfolio
at NAV literally in about 3 months. So there's this idea of an illiquidity discount, forget it. There, that market is, and funny enough, I took a call only yesterday with someone asking if there was any way they could buy any of the stakes that OCI had.
Oh, really? Okay.
So that's we have that on one side, and on the other side we have generally a misunderstanding of investment trusts, and then within investment trusts,
doesn't help. That's got its own problem. Yeah.
The name's hopeless for a start.
Yeah,
trust doesn't conjure the right, and then you've got under alternative investments, they're just not particularly well known. I was speaking to a Californian pension fund, state pension fund, 2 weeks ago, who said, in their mind, it's very clear that the attitude towards private equity in Europe is about 10 years behind the US.
Yeah, as most things are.
In the US, that you're increasingly seeing a real retail drag, to force pension funds and investors to make sure they're exposed to private equity. Private equity, and it's a point of pride, investing in your local economy and the businesses that you use. and understanding the majority of those aren't on the public market.
And let's be honest here, I suppose, just to finish off, if you look at local government pension schemes, for instance, which is local authority schemes, they quite often invest in private assets.
They do.
They do it already. So, and if you look at, and in fact, I'm always struck by it when you do surveys of big institution investors who run your pensions, they're all over private assets.
Absolutely. And so this idea that this is a nefarious, dark, sinister group investing in these investments it's the same pools of capital that invest in public equity, invest in private.
Just different structure. It's
just as individuals, you may or may not be. You may just be focusing on public equity and thinking that private equity is either too risky. It's debt laden, the model's broken, the valuations aren't what they say they are, and there are so many of those are either manager dependent or just frankly missed that are easily busted.
And I think I'd finish by saying two things, which is over the last couple of years, one of the biggest funds in the UK, Scottish Mortgage, very successful business. Lots of investment trust people have gone into it. Has a big pool of private assets. Big pool, I think in their case up to 30%. So that's the biggest investment trust in the UK. And the second thing I suppose I'd also say is we are quite lucky in the UK, which is that it's not a vast number, but that pool of listed private equity firms are all quite high quality. And it's not even, you go to America and you don't get that pool, actually.
No.
The UK pool is actually quite good and quite transparent in its reporting. And we're actually paradoxically quite lucky in the UK to actually have quite a good listed private equity sector. But
I agree. A number of them have been running through cycles, which I think helps. Yeah. They've been through the GFC. There's been some natural selection.
Yeah.
I completely agree with you. It's a universe that I, happily invest across.
Yeah.
And they all reflect, kind of European and in some cases global private equity opportunity as well.
Yeah. Anyway, I think we've run out of time. Stephen, thank you very much. And absolutely go and look at OCI. There's also a wider group of listed private equity players in the market, worth looking at all of them, worth thinking about in terms of your portfolio. No one's suggesting go and stick all your money in. Well, sure, Steve would love it if you did that. But no one's suggesting stick all your money in it. But I think you sort of have to ask yourself, if the world's going private, you maybe want to have a little think about it, if nothing else. Anyway, I hope you found this interesting. Join us for the next episode. In the meantime, happy investing.